Another option for resolving federal student loan defaults is federal student loan consolidation. The way this works is a borrower obtains a new federal loan through the U.S. Department of Education. That new federal loan pays off the old federal loan, and then they make payments on that new loan. Now, you don't have to consolidate just defaulted loans. The direct loan consolidation program is available for both defaulted and non-defaulted federal loans. However, if you are including any defaulted federal loans in a direct federal loan consolidation, the borrower is required to select an income-driven plan. Now, the fact is, for most borrowers who are in default, income-driven repayment is going to be the best plan for them anyway. So it's not really a penalty so much as it's just a requirement that tends to make sense. But if you were just consolidating non-defaulted loans, then you wouldn't necessarily have to select an income-driven plan. You can get onto any plan you want, any balance-based plans, or the other thing to keep in mind with consolidation is that I mentioned this earlier. If you've got a mix of FFEL program and non-FFEL program loans, you have a mix of direct loans and FFEL program loans, or just FFEL program loans. Doing a direct loan consolidation would convert those loans into a direct program loan. A consolidation loan is a direct program loan. And then, even though FFEL program loans are not eligible for certain repayment and forgiveness options like ICR, pay-as-you-earn, revised pay-as-you-earn, public service loan forgiveness, by consolidating, you can convert those non-eligible loans into an eligible direct loan and then have that direct loan be set up for whatever program makes the most sense for your client. So that's something to keep in mind. There are these other benefits to consolidation in addition to getting loans at default if the borrower has defaulted federal loans. So no payments are required if the borrower selects an income-driven plan. It's a bit faster than rehab. So rehab is those 9 payments over 10 months. The consolidation process typically takes about 30 to 90 days from start to finish. So it's a bit faster. The credit report benefit of consolidation is good. The defaulted loans or the old loans will get marked as paid in full, but the default notation on the credit history does remain. So there's a misconception. I think some of this is perpetuated by some debt collectors that rehab is good for your credit report and consolidation is not good for your credit report. That's not how I frame it for my clients. I say that both are good for your credit report, but rehabilitation might be a little bit better. It's a marginal benefit. It's not a huge benefit. Essentially, if borrowers either are not eligible for consolidation or if their credit report is absolutely their most important goal, maybe they want to buy a house in a year or two or something, then rehabilitation might make more sense there because it's a bit better. But consolidation is still good for your credit. Collections costs. So again, there's that 25% charge that gets tacked on to the loan balance just as a virtue of going into default. Those collections costs will get capped at 18.5% if the borrower consolidates to get their loans at. So again, it's still absurd. It's also a reduction, so that's sort of good, I guess. But 18.5% is still pretty substantial. It's still also an improvement. It's a little bit more than the 16% under rehabilitation, but to be honest, I think it's mostly a wash. That 2.5% difference likely will be made up during the course of the borrower making 9 payments over 10 months. So that's just something to keep in mind as well. Just like with rehab also, the Department of Education and Practice is not charging the full amount for consolidating defaulted direct loans. They're charging a few percentage points in collections charges, not the full 18.5%. Again, they're not required to charge less. They're capped at 18.5. They could charge that. They're just choosing not to. That could change at any time, so I counsel my clients on that as well. Like rehabilitation, consolidation is also a one-shot deal in that once you consolidate all of your federal loans, you're not able to reconsolidate that loan by itself. If you go back to school and you take out another federal loan, you could do another consolidation between the old consolidation loan and the new loan that you just took out, but you can't reconsolidate a direct consolidation loan by itself. And that's something to keep in mind and something to counsel your clients. So there's a question, is there any way to consolidate private loans with a federal direct consolidation? The answer, unfortunately, is no. You cannot wrap a private student loan into a federal loan at all in any way through consolidation or not. there's no way to do that, unfortunately. Senator Elizabeth Warren did propose a bill a year or two ago as part of her refinancing initiative that would have allowed borrowers to consolidate their private loans into a federal direct consolidation loan. That bill didn't pass. Doesn't look like it's going to pass. So that's where things stand on that. But right now, no, there's no way to do that. There are private loan refinancing programs that allow borrowers to consolidate their federal loans into a private loan, a private refinanced or private consolidation loan. So it's possible to go the other way, but I strongly caution people about that because once you turn a federal loan into a private loan, because you can't consolidate back into the federal loan system, it's effectively a one-way street out of the federal system. You can't get back in. So you lose access to all of these safety nets, all of these programs that you otherwise would have. Now, for some borrowers, I see a lot of this with doctors and lawyers who are making good incomes. You know, they say, look, the interest rates on my federal loans are absurd. They're 6, 7, 8%. I can get a lower rate if I refinance through a private lender. You can do that, and maybe the interest rate is worth it for you. But I always counsel people, I say, you have to understand what you're giving up. Maybe you don't need income-driven repayment right now. You're making good money, but you don't know where you're going to be in 5 years or 10 years. And you really got to understand what you're giving up because you can't go back to the federal system. So just something to keep in mind, to keep in mind, to keep in mind.